We're going to begin with the crash of the Titans. Wall Street in panic mode this morning. Comes after one of the most dramatic days in financial history, which put two of the nation's most respected financial firms into a tailspin. Sunday night, a sign of the extraordinary times on Wall Street as thousands of Lehman Brothers bankers packed up their boxes.
You know, never thought it would come to this. It's just a tragedy. 25,000 employees and...
Two titans in finance, century-old Merrill Lynch and 158-year-old Lehman Brothers, are no more. Weekend talks started with Lehman, with regulators and banks hoping to agree on a sale of the firm. But late Sunday, global financial group Barclays and Bank of America walked away, leaving Lehman bankers out on the street. Bank of America turned its attention on Merrill Lynch, an iconic American institution with $1.2 trillion in assets.
Because at Merrill Lynch, we're bullish on the future.
As the Merrill Lynch deal was hammered out, word came late that insurance giant AIG was struggling to raise $40 billion to stay afloat. How did this happen? Some would say greed and too much risk-taking as housing prices plummeted and mortgage investments went sour. Even infusions of cash failed to stop the bleeding. Bear Stearns was the first victim back in March, bailed out by the Fed and sold to J.P. Morgan. Now 3 of the top 5 Wall Street institutions are gone, belly up or sold to the highest bidder, with only Goldman Sachs and Morgan Stanley still standing, leaving many to wonder what will happen next and whether Americans can trust the system to keep their money safe. And Aaron Burnett covers the markets for CNBC. Aaron, good morning to you. Markets right now about 300 points down, but you said it could be worse.
It could be worse. That's a great way to put it. As you talk about it, over the past few months, we've lost 3 of 5 of this nation's investment banks. You might think the market would be awash in selling. The fact is, it's relatively well contained, and even if you look in some financial services companies today, they are trading higher. So there are serious issues, serious problems, but overall, rather calm here on the floor so far.
Why?
Well, you know, that is a great question. And part of the thing is that with Lehman Brothers, for example, declaring bankruptcy, you basically had an unprecedented uniform front of some of the biggest banks around the world. 10 of those CEOs standing up together and saying, look, we're going to put money in a fund. We are aware of the issues. We are going to try to address it. And that is significant. And then the other good thing that is helping out the market a bit is Merrill Lynch. You see Lehman's trading at zero because it went bankrupt.
Right.
Bear Stearns sold for a very small amount of money. Merrill Lynch got $29 a share, and at this very instant, actually, you're seeing the CEOs of Merrill Lynch and Bank of America shake hands. Proof a deal can get done, proof there is some value in the market, and that is providing a bit of a floor as well.
Why didn't the federal government bail out Lehman Brothers?
It's what they call a moral hazard issue. Once you step in and say you're going to provide a bailout, if you had a credit card, problems with your credit cards, and I bailed you out, what's to say that Matt Lauer and everybody else can't come and want to bail out
too? But they did it for Bear Stearns.
At the time of Bear Stearns, I guess you could say we were all perhaps a bit naive, Meredith. No one knew, quote unquote, how systemic the problem might be. There was a real fear at the upper echelons of regulation in this country and at the Fed that if Bear went down, our entire economy could be at risk. This time around, there was more warning. People were a little bit more prepared, if that's something you can say about this scenario. And I mean, look, $600 billion of assets Lehman has, and this market will, in an orderly fashion, be able to address that. And that's a significant statement.
You know, there are people waking up this morning who have their money invested at Lehman. Did they lose their money? Can they get their money? What happens to the money?
If you invested in stock of a company, in Lehman Brothers shares, if you didn't sell in time, you're not going to get your money. Investment means risk in this country. But if you had a brokerage account, that is a different story. Just like when you have a bank account, the FDIC insures up to $100,000. A brokerage account can be insured up to $500,000. So if you had an account and you had, say, Google shares in it, you can get that back. And that's important. And on the insurance front as well, AIG is going to be a name so many people are talking about. It's lost half its value. A lot of people have auto policies or insurance, life insurance policies. Insurance in this country is regulated at the state level, but likely you can get much of that back depending on your state.
Is that likely to go belly up, or is there any way it can save itself at this point, AIG?
Right now, it is uncertain. The goal and the hope for everyone is that they will be able to stay afloat. Look, when you look at solvency, is a company good for its money? The answer for AIG is yes. The problem is it's not really that liquid. So right now, they're going to the Federal Reserve. They're asking for a lifeline. If they can arrange for that, they likely will be able to hang in there, but there may be another merger there or consolidation.
And what about down the line with other places like Smith Barney or other investment firms? Are they all teetering?
They're not all teetering. There will likely be more consolidation. And some of the companies that we're all familiar with when you go bank every day, the quote-unquote commercial banks where you deposit money, those may be the companies that end up merging with some of these brokerage companies. It will be a smaller playing field, but it will be perhaps a more secure one.
All right, one final question. They're telling me to wrap up. But if you have money out there in one firm, are you better off diversifying, spreading your money around to different firms?
I think you should. Right, you confirm the amount that you can have, like at a bank, as we have said. Don't have more than $100,000 in any single account, so that you can make sure you get insured. Same goes for the brokerage. Keep it under $500,000. Confirm with your broker what would be covered, and make sure you keep it below that level, just to be safe.
Okay, Erin, thank you so much for your